Good afternoon, ladies and gentlemen. Happy Friday, July 5th, 2019 to you all. Welcome back to our first full day of trading after sort of our shortened week. Day of the market closed yesterday and a half day on Wednesday. Well, it's great to see you all here for our open forum Q&A discussion. For those of you who don't know me, my name is Mike Chupka. I'm the Director of Education here at PowerOptions. Doing something a little bit different today. I'm going to record the video from the beginning, and the reason why is because I want to just, for a part of our discussion that's going to happen, the very first question that came in via email from Lance, we're going to talk about this time decay curve. It's going to come into play in our discussion in just a moment, and what I'm talking about there is the decay here of whether you've bought an option or you've sold an option. You see the rapid time decay in the last 30 days, and very rapid in the last 2 weeks or 14 days. But with options that are further out in time, you have a much lower percentage time decay. You're going to see that in action for this discussion a little bit coming up, but I just want to keep everyone in mind on this little trick here. A standard of options investing, the time decay curve. Why is when we're selling, we want to sell near term, and typically when we're buying, whether for protection or whether for speculation, we want to be going further out in time. But let's take a look first at what we do in our weekly presentations. First, what is PowerOptions? Well, PowerOptions is a one-stop shop for self-directed options investors. We're a patented suite of tools that allow you to search across the universe of options and over 23 of the most commonly used strategies to find only the positions that match your personal stock and option criteria. I can tell the system to just find me covered calls on stocks with high volume, low beta, high dividend percentage, and ex-dividend date coming up in the next 2 to 3 weeks, no earnings between now and expiration, with a call premium that's less than 20 days out in time, has a time value of at least 2%, minimum open interest, certain delta or probability of being assigned, and more. You can also do that for spread positions, diagonals, straddles, strangles, and more. You can also, of course, research the stock and the option with some of our detailed research tools, analyze the position, run what-if scenarios, and then we offer a powerful set of portfolio tools to help you track and manage your positions, where you can even link to another tool called the Position Analysis Tool, which will show you rollout opportunities where we do the math for you, but you can see managements to either increase your return, roll or adjust the position, limit risk, potentially bulletproof the trade, depending on your structure. Of course, we offer countless help videos, articles, blogs, and archive webinars, not only to help you get familiar with the tools, but to also get insight into the various option strategies, search criteria, what works, what doesn't, management techniques, and more. Ernie's Renner created PowerOptions back in 1997, but everyone here on staff, myself included, uses these tools to trade our personal accounts. We have many more years of combined trading experience. Now, for our Friday open forum Q&A sessions, our process and procedures. When you logged on to the webinar, GoToMeeting, GoToWebinar platform would have appeared on your screen. Inside that platform is a question pod. Use that question pod to send me any questions at any time during the presentation. Now, we're scheduled to be here from 4:30 p.m. to 5:30 p.m. Eastern Time, but if we have a high volume of questions, I'll be more than happy to stay online to make sure everything is answered. Questions can be about anything related to options investing. Whether you've got a question about general options strategy. What is a covered call? Should I go in the money or out of the money? What's a good bull put spread? Is it better to take a lower risk-reward ratio on a bull call debit or a credit spread as opposed to looking for a higher probability? Maybe you have questions on trade management. You're in a position that you might need a stock repair, suggestion, a roll opportunity for a spread position, covered call, or maybe a naked put. Maybe you just have questions about option specifics. What should I look for implied volatility? Should I manage my spreads before or any position before I get to expiration? Maybe you even have questions about the basics. What is delta? What is gamma? What is out of the money? What is in the money? That is all fair game. Some of you might have questions about setting up a particular search on PowerOptions or using one of our signature tools. That's all fair game. And of course, you may have questions about the concepts of the limited risk, married put, radioactive trading techniques as well. Now, basic ground rules. Don't be shy. Ask any questions that you want at any time during the presentation. Be patient. There might be one or two questions ahead of yours, but as I mentioned, we will get through them all even if we have to stay on a little bit longer. I also encourage you to feel free to help us help others. A question comes in, I give a response based on my market experience, conversations I've had with other investors or with Ernie. But you have a different way of analyzing a position, a different filter you like to use for getting into a certain trade or stock position, a different management technique that I didn't bring up or didn't think of to adjust this particular position in a discussion. Share that with us. We'll share it with the rest of the audience as well. I may, of course, ask you for clarification on your question. There's a lot of names out there, a lot of different strategies, a lot of nomenclature that's thrown around, so I want to make sure we're looking at the same thing before I start breaking down the position and what looks like it's working, what's not. Most important, of course, let's have fun. Let's get some good education under our belt. I know some of you, of course, had a long weekend, or I should say are going into a long weekend. You might have taken the last 2 days off as well. But let's get ready to continue to have some more fun, but start by getting some good education under our belts and getting ready to start next week, another full week of trading. Now, all that being said, this is kind of one of those million-dollar questions that's probably nagged all of us or probably come to us at one point or another in our trading history, even if you're just getting started. Lance sent me an email this afternoon, and Lance wanted to know, and I'm looking to build my account quickly by compounding my gains once the profit target is achieved. I only want to risk 5% to make 10% as an example and then redeploy those funds. Is a married put strategy, and by extension the idea of bulletproofing the trade, which we talk about in the blueprint, ideal for quickly rotating my capital once my profit target is achieved, or is that too capital intensive and too slow, assuming I only want a 2 to 4 week holding time? Is another strategy ideal, and can PowerOptions assist me in finding appropriate trades? Whew. All right, great question. Can I only risk 5% to make 10% consistently, compound it? If what you guys do in your portfolio with part of your portfolio is not doing it, what can be done to do that? And of course, can PowerOptions help me find the trade? Well, let's break this down a little bit more. Can the married put structure that we teach, and married puts in general, only carry a 5% risk where you can't lose more than that even if the stock falls 30%? Yes, absolutely. Can you see a 10% return with married puts positions? Absolutely. We can see returns of 10% or more using the income methods discussed in the blueprint. Now, can I quickly rotate my capital once that 10% target is hit, say in 2 to 4 weeks? Not likely. That is too short of a time frame to expect a 10% consistent return on a stock alone, let alone a stock that has some extra cost into it to be conservative with the married put. The married put is about conserving and avoiding losses so that you keep more of the gains that you do have, but there's no free lunch. All right? We know stop orders don't work. Everybody out there knows, of course, that we've all tried stop orders in the past, and in that case, going forward, and we've all been violated by stop orders. Stock falls 20% from unexpected news, not even related to earnings. We set our stop at 5%. We wake up in the morning. We're closed out at a loss of 20%. The market can only give us what the price is. Can't get us out at 5%. Is there another strategy ideal for this target? Not exactly. We're going to discuss why. Now, I do have a comment that I think came in from Manny, is it, I believe? M-A-N-N. I don't know if it's Manny, actually. And I'm going to get to that, your comment there, when we get a little bit more in the presentation. But it's kind of where I was leaning as well, looking for that. But we have to discuss one other thing, too. All right. Now, our preferred structure, radioactive trade for the married puts, is I might look to buy Intel today. It came up on the married put search after I received Lance's email. And I might buy Intel at 48.09, and following the radioactive trading techniques, I might buy a January 50 strike put, priced right now at 460. Okay? Now, my total invested is 52.69. My apologies. But remember, the put gives me a guarantee. Unlike a stop order, I can get out at 50. So for the next almost 220 days, well, about that, you know, we go about 6 months out in time. So it's a little bit about 200 days out in time. I'm only risking $2.69 269 for 100 shares in one put, or 5.1% of my total investment. Right? There's our 5% risk. To get a 10% return on that investment of $52.69. Remember, I got to consider not just the stock, but what I invested total is $52.69 or so, I think it was. So the return might be around $5.25 or $5.30. In order to get that in the first 4 weeks, roughly the first 30 days, I need the stock to be trading at about $57 per share. Well, that's a $9 increase from the 48.09 we're in now in 30 days, 18.8% gain in a 30-day period. The stock would increase that almost $9, $8.91, but using the Black-Scholes pricing model, we'd expect the put to lose about $3.60. But overall, gain in the stock minus loss on the put, with this gain of 18%, that would give us the 10% return. Right away, you start to see a problem. How often do we pick stocks that gain 19 to 20%, or even underlyings, I can say? You might be doing just a call option or buying a put option expecting a 20% decrease. How often do we pick those? Personally, I don't that often. They're hard to come by. And if they're a more volatile stock that has an event coming up, well, it's harder to get that 5% risk, because the implied volatility in the option is going to be increased, and that put option is going to be much more expensive. Okay, so let's just throw away the over 10 years or so that Kurt has tested the married puts and the radioactive trading techniques. I'm sorry, almost the 20 years, 15 years, and the 10 years that Ernie and I have been using it in our personal accounts, and say, well, isn't it better with just a 1 month out OTM put that's cheaper? Well, you get what you pay for, right? Until at 48.09. Instead of doing a radioactive 6-7 month out put that's slightly in the money for that better protection and less time decay, as we talked about at the very beginning, we see a much slower time decay. I'll show that in a moment. Buy an August 47 put at 137. You might say, well, why not buy the 45 put? And it might only cost 40 cents. Yes, but now the risk is up to 9% because the insurance doesn't kick in until the stock falls. To get 5%, we have to be at the 47 strike. Total invested, $49.46, not bad, $3 or so less than what we had with the longer term position. We're guaranteed to get 47 back in the worst case scenario, so again, we're risking $245 or roughly 5%. Standard August expirations is 42 days out in time. All right, now, but again, first 30 days, July 5th to August 5th. We only need the stock now to go up to $54.50, an increase about $640 to get our 10% gain. Because what's going to happen to this put option? This put option is going to zero quickly. That time decay curve, the last 30 days, we're seeing a rapid time decay 30 days and out, where the 220-day option is still only seeing a small time decay. We know, what do we know? The one guarantee about options is you get closer to expiration, the time value goes to zero. This put was all time value. Did only carry the 5% risk, but you need a 13.5% gain in order to get to the 10% gain, that $5.04, because remember the cost base was only around $49.60 at this point, so you need about a $5 gain to hit your 10% target. I'm sorry, $4.94. You need 5% gain, $5 gain. $5 gain gives you the 10% return, but you need 13.5% in the stock in 30 days to see that. All right, we know the worst case scenario, you can only lose 5%. We just showed what you'd need to make 10% in both of these positions, okay? And if the stock stays right at 48 on August 16th, near-term expiration, which was 42 days away, a little bit beyond your 2 to 4 weeks, but that OTM August put that was cheap, you lose $1.37 on the put. You lose 9 cents, just a round number here. We're going to lose 9 cents on the stock because we bought it at 48.09. So we're down a total of 146. Your 47 put expires. Lose all that time value. You're down 3% on 49.46 invested. On the other side, of course, using the Black-Scholes pricing model, we're using that January 50 put. The stock stays right at $48. we only lose 55 cents. Why? Because of the time decay curve. Less than half of what we're losing with that cheaper out-of-the-money put. Lose 9 cents on a stock, we're down 64 cents, or only 1.2% on 52.96 invested. I wanted to illustrate that just because it's not cheaper. Okay, the idea of a cheap insurance only works if you're right. Okay, now, man, I see your questions. We're going to use a certain tool to illustrate your points. I already have that planned out a little bit, so just give me 1 second. You know, okay, I'll say it right now. The man's comments are, instead of this target of 5 to 10, why not target a 1 to 2 risk-reward ratio? Risk 1% to make 2. Or on the other side, risk 2 to 4. We're going to take a look at that. Okay, so let's go back to our discussion here. To Lance's direct question, is it possible? Yes. But trying to see a 10% return on a stock position, just think about a stock itself, without the married put, you'd need a 10% gain. How often do you pick stocks that move 10% in a 2-week to 4-week period? Is it possible with the married puts? Yes, because you've got the insurance in place. But you're going to need to see stocks that move 13 to 20% on a regular basis every 2 to 4 weeks. That's difficult at best, even in a strong market. Our hold time for the 10% target we discussed with the married put that we do is usually 3 to 4 months. In bad markets, it might be longer. But the idea is the trade as a whole, on the ones I lose on, I'm probably losing less than 5%. I think my average is a 4.4% loss on my losing positions, and my gain is not as high as I'd like right now. It's about 7.9%. But I'm not trying to roll every 2 to 4 weeks. I'm giving it time to progress. So it's a little bit slower. It's not as actively trading, but it's the structure that pays for itself. Okay? Okay, here's a problem, and I'm going to have to illustrate this. James, I'm going to come back to your question after we have a couple more comments here on the risk-reward ratio and some other comments here, James. I'm going to use the tool and PowerOptions to discuss this. Okay. And it kind of relates to this. All right. So what we call income methods in the married put structure helps, but selling a call will cap the gain. Selling the call incorrectly will actually give you 2 ways to lose, and you can lose more on the upside. This is related to James' question, which I'm going to show later. Can you do weekly covered calls with a radioactive married put? This will pay for the married put. Selling a call is the first income method of the 12 talked about in the blueprint, James. Do you want to force a weekly covered call in that position? You don't. And I'm going to show you why in about 7 minutes. All right, so rolling the put, adjusting the put, the benefit of having that farther out put is I can manipulate it. It's actually a second asset that works in my favor, not just to give me insurance, but it might increase the cost, even though it lowers the risk. It might decrease the cost basis and increase the percentage at risk. That's what we talk about in the blueprint, when and how to use these 12 methods. But we are not expecting 10% returns in 2 to 4 weeks. I've had the luck of it. I think I got into a Red Robin buried put a few years ago right before their earnings. The stock jumped 35%, and I think in 3 weeks I got out with something like an 18-19% return. That's not consistent. If it had dropped 30%, I would have only lost 5%. But again, that doesn't mean that every married put on earnings is going to give you that gain. Sometimes the stocks will gain 2 or 3% for earnings or lose 2 or 3%. Covered calls alone naturally won't do this. You're talking about 10% per month. Even if you're using weekly options, some might offer the potential of a 2% return week by week, or even 2 weeks at a time. You might see a 4.5% maybe return. Maybe not. Really, an average return on a weekly covered call at the money is about 0.7%. So yeah, over the course of 4 weeks, you might be at 2.8%. That's not going to work. And you have to use a stop order because you can't guarantee stopping it at a 5% loss. Something falls 10% overnight, you're at a loss of 10%. Your system's out of whack, right? You can't do this with standard collars. You can do a standard collar where I buy a stock, sell an out-of-the-money call, and buy an out-of-the-money put and have a risk of 5% or less, absolutely. But I'm not going to get a 10% gain. Even if I bought a 1-month out put, that August put on Intel 47 strike and sold weekly against it, that might not even pay for the 137 cost. But again, you're not going to get close to that 10% gain. Okay? So let's lie with leverage. And I don't mean that we are going to lie in bed with leverage and use that to achieve your goals. It's a possibility, but what I mean is the lie of leverage. You could just buy an August 47 call and easily see a 10% return. Hopefully, if the market goes up as you expect. The August 47 call right now is at 240. Well, 10% gains 24 cents. Stock moves up 50 cents tomorrow, or even 35 cents, 40 cents. I'm going to have that 24-cent gain. But are you risking 5%? No. You're risking 100% of whatever you invest in that position with a long call trade. Okay. This is where the parity comes in. People say that long call, buying the August 47 call would be the parity to buying the stock and buying the August 47 put. Well, it's not. Why? Because if I had a $50,000 account with that Intel structure, the risk came out to be about $260, right? Okay, so I might only want to risk 1% of my total portfolio, $5. I'm only going to use 200 shares and 2 puts so that the total monetary risk only represents 1% of my portfolio, about $500. And if the stock falls, what happens to the Mary put? It only loses 260 times 2, or 1.4% of my total portfolio. Well, most long call investors are going to come at me and say, I'm only going to risk 5% of my total portfolio in long calls, right? $50,000 account. 5% of that is $2,500. Should have been a dollar sign there. You could buy 10 contracts. Remember, the August 47 call was at 240, so you're investing $2,400. Your call moves up 10%, 24 cents. Fantastic. You've got your 10% return. $240 on $2,400 invested. It might happen in the first few days. But this is only 0.5% of your total portfolio value. Based on what you're saying about growing your account quickly and compounding it, is that kind of structure of a long call going to do it? Because to be safe, you're doing a limited number, and by no means am I saying you should just do 100 contracts and do 50% of your portfolio and hope to get the 10% return. Good grief, no. Why? Because with just a 30 to 40 day out call, even a weekly long call, you could see 100% gains with some luck. But with just being 2 weeks out or even 4 weeks out, you're also likely to consistently see 70, 80, or 100% losses. Not just due to a bad market, but remember that rapid time decay in the last 30 days. Whatever portion of that short-term long call was that was time value, you're going to see start to decay very rapidly. Are there leverage positions that you can use that give more protection? Well, we've got diagonal spread. This sort of goes back to what I think it was MAN, and maybe it was even Lance. The name wasn't coming through correctly. Diagonal spreads, bull put credit spreads, out-of-the-money call debits. See, if I do an out-of-the-money bull call debit spread, remember Intel was at 48. What I might do is sell an out-of-the-money 50 call and buy an in-the-money 46 call, let's say, 2 points apart. Well, this is a bull call debit spread with the stocks trading right in between. Why is this important? Well, the debit's only going to be around $2. And if the stock's above 50, I get out for $4. So I have a 1-to-1 risk-reward ratio. Or I move it a little closer. I do 49 to 47 or maybe 49 to 46. That might be this ratio of 1 to 2. Okay? Looking to make 200% return with a lower cost. Or instead of the 5% risk to 10% return, do the half, 2 to 4. A very protected collar with a potential for 4% return. These exist. But in order to get them, you have such a low probability of making that return. You're probably only going to be right 40% of the time, 35% of the time, when you set up a ratio that's only 1 to 2, risking one portion, let's say $1 to make 2, risking 2 to make 4. Those structures exist, but have a low probability of consistency. All three of these are leveraged with a low debit or relatively high net credit. You're talking 10 to 15, maybe even 20% returns in shorter periods of 2 to 4 weeks. I think the average of my 2-week out bull put credit spreads is about 13.3% for this year, and I'm right about 83% of the time. But all three of these strategies do what? The lie of leverage. They all carry 100% risk. Whatever you invest in a diagonal calendar spread, even an OTM bull call debit spread or a bull put credit spread with a higher probability, you can lose 100% of whatever the debit is in that strategy. Now you say, I'm making only 5% of my portfolio, so it's fine. What if you open 10 positions that have 5% risk and you lose on 6 of them? That's a 30% decline, isn't it? Okay, so you make a little bit on the others, but you're just nearly at break even, still at a little bit of loss. Okay. All right, so what we need here is sort of a trading plan than a straight answer. It is unlikely that one strategy will help you reach these goals. Not only because it's a little bit excessive, but because the markets are different. Markets are always changing. Married puts look long-term to preserve your capital, as do standard callers, to preserve your capitals more and still get positive returns and stay ahead of the skew. But you're not going to do that every 2 to 4 weeks. It's very difficult unless you can consistently pick stocks, as we showed, that make 13 to 18%. Yes, I'm looking to keep my losses on my Married puts below 5% and have my gains up closer to 10%, but my holding time is about 180 to 210 days, somewhere in that time frame, a little bit more than 6 months. I was averaging around 110 to 120, but the markets over the last 8 months have precluded me to hold positions longer than I wanted to manipulate them more to get to target goals or positive returns. A combination of protected positions, a larger portion of your portfolio, and leverage positions, probably less than 15% of the total portfolio, is a better play. Personally, I think 10% return in 2 weeks or 4 weeks, even with levered positions on a consistent basis, is unrealistic. Think about it. And we're talking about making 10% on all the gains. Yes, we're going to take 5% losers on some, but that's close to 120% per year or more if you're right 100% of the time. I think that's slightly unrealistic, but let's see. That's my opinion. So let's ask you guys, what do you think is a reasonable return over the course of a year with your options trades? Do you think a target is 100% per year or more? You started with 50,000 this year, you're going to end up with 100,000 at the end of the year, and then next year 200,000. Do you think 50% per year is a reasonable target? Do we think 30 to 35% per year on your total portfolio is a reasonable target? 20 to 25% per year, or anything above 5% is just gravy? All right, so just let me know what your targets are. There's no wrong answer. I don't want to leave this open too long. We're almost at 5 o'clock, which is fine. I do have some other questions I wanted to address that have come in. A lot of you are participating in this poll, and I'm very thankful for that. And I'm pretty sure this poll is going exactly how I expected. One little difference, but I think it's going about as I expected. And of course, I could have thrown other numbers in there. Some of you who are answering one might have been looking for another number, but that's okay. All right, let's close the poll. I've had it open for longer than a minute. Let's share it with everyone. All right, so 8% of you think 50% or more per year is reasonable. Aggressive strategies, leverage strategies, I'm assuming that's great. Or you guys are really good stock pickers and putting me to shame, but that's fine. You think that's reasonable, that's great. 8% say 30 to 35% is a reasonable target. Now, the majority of us split. 42% said that 20 to 25% per year is a reasonable target, and 42% said anything above 5% is just gravy. This is talking mainly just about with the options portion of your portfolio. No one said 100%, which means no one is really expecting 100 or 120% per year. Of course, I know that's not your target, Lance. You said 10% gain is your target on the ones you win. You're expecting some losses, but you're trying to skew the results in your favor. I get that. Okay. Now, the thing I mentioned about, I just put anything up, they only give me 5 choices, excuse me, but I said anything above 5% is just gravy. if I would have narrowed this down more, started at 50%, I just want to see if anyone would answer 100, but if I started at 100 and then put another range in that was, say, 10 to 20%, and then anything above 5%, I think for some of the 42% that answered 20 to 25 would have gravitated down, and I think more of the 42% would have gravitated up. So I think the three answers would have been between the three, would have been a three-way tie between 20 to 25%, 10 to 20%, and anything above 5%. Okay. Well, you know I can't have one without the other, ladies and gentlemen. You don't have to answer this if you don't want. I'm just curious. What returns are you achieving with your option strategies so far this year? Keep in mind we're at the halfway point. June expiration was the 6 standard expiration, so we're 6 standard cycles through the expiration year. July 1st is technically the midpoint of the year, about 182 days in with 183 days to go. So what are we achieving with our options? Are we achieving that 10% per month or 120% per year? Are we seeing about 8% per month, which would roughly translate to 96% per year if we get that on a consistent basis? 5% per month would be 60% per year. 3% per month, 36% for the year, of course, or 1 to 2% per month, 12 to 24% per year. I'm on the lower one. I'm going to be honest with you. Last year, I was a little bit above the lower one. I was a little bit above 2% total per year, above 24%, even with 6 of the 12 months being negative market months. The year before that, I was in that 3% range, but that's first time in 5-6 years I've achieved that. So I'm usually 1 to 2% per month. That's my target goal, and this is with, I'll explain that in a moment, different strategies that are being used. Okay. Ben does say that he's negative so far. I didn't want to include that because I understand your answer, and I'm sorry to see that. And you know, we're going to try to help you with that as best we can, Ben, just like everyone else here today. I don't want to see negative, but I just want to see who is achieving. So let's close the poll now. It's been open for more than a minute. About half of you have answered. That's fine. Some of you who might have lost didn't answer. Some of you don't want to answer because you think it's too private a question. That's perfectly fine. Where's our disconnect? Well, 42% of us say that 20 to 25% is reasonable, and 42% said above 5% is just gravy. 75% of us are making 1 to 2% per month. So that's close to that 20 to 24%, maybe 12 and so forth, in that range. 25% are doing great. You're doing fantastic. 3% per month or about 36% per year. You're in that higher range, that 8% that answered that they think 30 to 35% is reasonable. You're actually achieving that. That is amazing. That is great. No one expects 5% per month, 8% per month, or 10%, but no one's achieving that. Okay? And think about where we started on January 1st. You know, we were just at the end of that lull to December 6th, and then the market shot up. We could have found stocks that moved 18, 13% as we were showing earlier to be successful, get that 10% return with the married put. But again, let's not. Not all of us are seeing that. The market has done other things to us since then. All right. So, in general, this is just my portfolio. You've all heard me say this on other webinars. About 50% of my portfolio is in the married puts RadioActive trades. 15 to 20% I use in bull put credit spreads following the weekly bull put selections on PowerOptions. You all will see a product which has a more in-depth discussion and reasoning and why that's being done there soon. 10 to 15% diagonal spreads. It might be calendar calls, might be calendar puts. About 5% really. I say 5 to 10%. It's really about 5%. Taking lottery tickets on straddles around earnings. Okay. And then about 3% or so I'm buying calls on the VIX, and that's really to just protect the bull put and the calendar part, which risk 100%. So if there's a sudden market correction, February 5th through 9th of 2018, October 5th of 2019, December 8th through December 16th or 17th, the calls on the VIX that I had countered the losses that I was taking on the bull put spreads, closing those early, getting out when I could without taking the 100% loss on the bull put or the calendar spread, and then taking the profits on the VIX to counter those two sections. Sure, the married puts were declining, but there's other ways that I could have made money and did make money on the downturn in that structure. Okay, so that's just in general. This is too aggressive for Ernie. Ernie's older, right? I'm 43. Ernie's much older. And what I mean by that is he's trying to preserve his capital more. I know you're trying to compound and grow your capital, Lance, but that approach that I use is too aggressive. Ernie's much more conservative, and you can check that out. If you go to blog.powerop.com, search for a balanced approach for portfolio success, I have the link there right for you, blog.powerop.com/2015/04/02/balance risk versus reward. And this talks about the barbell strategy where 90% of the portfolio is in conservative positions and 10% is in highly speculative high-risk reward. Well, for Ernie, this means he still wants to be an active trader. This means roughly 90% is in married puts and positions that he can bulletproof, reduce the risk. I think his average loss is lower than mine. It's only 4.1% on a position. Does bulletproof positions as well. And then about 10% of that portfolio of his, he's older, he's retired, he just hangs out at PowerOptions, does his trades, answers some phone calls for you guys, and takes coaching sessions when I'm not available. But 10% of that portfolio is in the other strategies, maybe buying calls, buying puts, maybe some of those straddles around earnings as well. But that's a good concept to look for as to diversification as well. Okay? All right. Let's see here. I'm just going to go through here. All right. Oh, yeah. Sure. Just give me 1 second, Lance. I'm going to post the link to that, send the link to everyone here in just a moment. There's some other moments some of the things I want to issue. Okay. So Paul says you need to annualize the 5% maximum losses to make a comparison between 1 month and 6 month married put. Okay. Paul, earlier, I don't know if you were here for this, but earlier I showed you what would happen if I did a 1 month married put versus the 6 month out. And if in the first 30 days the stock stayed at the same price, I would have lost 3% on the shorter term married put. So let's say that's 36% per year, but I only would have lost 65 cents or 1.2% on the radioactive married put, which only comes out to about 20% per year. Okay? The longer term put is better protection because it doesn't decay as rapidly as the shorter term ones. We talked a couple weeks ago, we talked about that. We showed how the nearer term, short term, 1 month out or 2 month out put option is going to decay much more rapidly. You're going to lose more in those first 30 days on that shorter term put than you would on the long term put where the stock moved up, stayed the same, or moved down. So yeah, you can annualize it, but those are the numbers that we would have seen for INTC. 3.2% loss, I think it was, on the near-term put if the stock stayed the same. 137, the full cost, time value for that out-of-the-money put, versus 65 cents or only 1.2% on the January 50 strike married put set up radioactively. Okay, so let's pause here. Oh, wait, let me one last review here. In addition to this, I'll get that link for you in a second. We transfer to PowerOptions. So was all lost? Did I completely just say to Lance, no, you can't, to spend the last 30 minutes saying, Lance, no, you can't do this. Married puts won't do that unless you get stocks that consistently move up 10 or 13%. Is all lost? Absolutely not. Is there another strategy that's ideal and can PowerOpt assist me in finding the appropriate trades? Maybe not ideal, but at any time we can give you the pros and cons by phone, via email, even on a webinar presentation, the pros and cons, risk and benefits of other strategies to help you meet your goals. We can help develop a trading plan based on our experience and what your target goals are. Keep in mind we are not financial advisors, but if you come to us and say I want to only risk 5% to make 10% and I expect a 52% success rate, will I be profitable and how can I achieve that? We'll try to walk through how to do that. No guarantees it'll work, but we can walk through the structures that would say yes, this would work. And of course, yes, the tools can help you find the appropriate trades in any strategy that match your trading goals, whether you want to control risk first and look for the returns later, or whether you want to evaluate positions that might take on more risk with the lie of leverage, trying to put in a trading plan and management technique to go forward. So all is not lost at all. We just need to delve into the structure a little bit more. Now, two things here we've got to do. First, I've got to navigate over to PowerOptions. 1 second. So for the topic on the blog, I'm just going to go to blog.powerop.com. And let's see here. I'm going to do the search text here. I could search for barbell. That's usually easier, but I could also search for that full name as I mentioned in the slide there, the portfolio balanced approach for portfolio success. But in any case, as I showed you, here is the direct link. I'll send that through the chat window there to everyone. There you go, blog.powerop.com 2015-04/02 balance-risk-vs-reward. That's the balanced approach for portfolio success. Okay. Second thing I wanted to do very, very quickly is I'm going to go to RadioActiveTrading.com. You heard me mention that, but this is where we discuss the married put techniques and the full technique for the 12 different income methods after that initial married put setup, where you can lower the risk, potentially bulletproof the trade where there's no risk, is here at RadioActiveTrading.com. Under the Resources tab, there's what's called the Trade Simulator. I'm not going to go through all of these examples, but some of those other comments came in that said, well, what success would you need? Why not just change it to a 1 to 2 or 2 to 4? This tool is going to help you with that. Let's say that I started with a $50,000 account, and I'm going to invest maybe 10% of that portfolio in each trade. I'm going to target a 10% win rate with only a 5% loss rate. Now, do I need a 50% win ratio to be profitable? No. So you can actually be wrong more often than right with this proper structure. Okay, and that's kind of what we look for in the married puts. Again, I think this is too much. As I mentioned, I think my gain's around 7.8% winners with 4.4% losers, and my probability of loss is only 40%. My investments may be a little bit higher here, about 25%, I'd say. So yeah, if you get right more often than wrong, you could take your starting position and really compound it. That is what you want to do. But remember, that's possible because of the structure, right? Oh, shoot. I hate when it does that. Yeah, you're right. It didn't click over. I'm so sorry. There we go. So let's clear this out. This is the tool here. So you can play around with this and set your numbers. Okay, so as I mentioned, I could put in 10%, put in 5% loss limit, probability of loss only 40% in this case. So this is like my actual trading record. Not really. It's a simulation of what I've been achieving with radioactive trading over the course of several years. Now, it's because of the structure, right? How can I get these 10% returns on some cases? But again, for me, that's 3 to 4 months out. It's not in 1 month. And it's because it leaves the upside open. And you can say, oh, well, again, why do this? Why not just do a long call? Well, remember, a long call carries a risk of 100%. Let's even say with management, though, you're reducing it down to 50. And your target return is 100%. And you invest 25% of what you allocated. Now, if you're right more often than wrong, you can be extraordinarily successful. Okay, but most of the time, this is more of a 50-50 win-loss. And in those cases, still doing very well, but how often do you really keep the loss to 50%? Most of the investors I talk to try to target a loss of 40% or so on their long calls, but they're only expecting a return of, let's say, 50 to 60%. So I'll say 55 and 35. And this is still good, but because they're closing their losers more often, their success rate is only about 40%. So you see here, if you start delving deeper into this loss area, you're going downhill. We started at 50,000. After 100 trades, the simulation might put us at 18,000. So you open up the losses more, allow it to go to 45. And I know these aren't the ratios you were looking for, but then I take the probability of loss down to 50. Now we can start potentially seeing the gains we want. But again, you could also lose up to 50% of your portfolio because of the lie of leverage. So you can run your numbers here, target return percentage-wise, loss limit, allocation, and what do you need to be successful, okay? Now, in these situations, like a covered call, for example, you might only be looking at a 2% return. But even with a stop order at 5%, you know you're going the wrong direction, but you might be right more often. Slightly in the money covered call 1 month out, offering only 2% return. Trying to use a stop order of 5%, where occasionally you might lose more than that. But only, you know, a probability of loss of 35%, 65% win ratio. Even, we got to get up to 67, I think. Yeah, see, going up to even 74 with that structure on a covered call, looking to make 2% every month, trying to control losses to 5%, being right 75% of the time over 100 trades might get you a profit to 56,000 from the 50,000 you started with. You're not going to see those 10% gains. The structure is correct. But with the married put, with the long call, to see that 10% return. But again, keep in mind, you're not risking 5% on a long call, you're risking 100%. So you need the 100% gains on those ones that you get a gain on as average, not 10%, in order to be profitable, even if you controlled it to 50%. Okay, that's the lie of leverage. And we saw earlier how even with that movement, even with the long call position there, that if you targeted 10% gain, well, you're only making 0.5% on your portfolio with the proper allocation, so that even if you lost 100%, that's only 5% of your total portfolio value. And again, is that compounding the way you wanted to do it? But check it out. Go to radioactivetrading.com, click on the Resources tab, then click on that Trade Simulator, put in the numbers of what you think is a realistic expectation of what you're able to control return on and risk. Yeah, you can. I did that at the beginning, Ben. It's you can run the numbers yourself. As Ben said, can you use a target return of 10? Yeah. So think about just a stock portfolio. I'm going to use a stop order at 10% when I'm wrong, look to make 10% when I'm right. You're probably going to be right 50% of the time. To start off with $10,000 and put them half in, what do we know? Well, what do you know is that you actually have to be right more often in order to make money. Even if you're right 51% of the time, you're losing. Why? Because the lie of leverage. A 10% loss doesn't mean a 10% gain to get back to break even. You take a 10% loss, you need an 11.1% gain back to break even. That's what this is showing. Even if I'm right 51% of the time, I might not be profitable based on the order of wins and losses because I need an 11% gain. And Ben says, sure, yeah, 10 to 5, yeah, absolutely, you can do that. And if you're right 50% of the time, you can do extremely well. But again, how do you have to do that? You have to do married puts and protection, which means you need 13 to 18% movement in the underlying to get a 10% return because of the cost of insurance. We don't hide that fact. That's obvious, but you get what you pay for. Okay? Yeah, and then Ben, okay, Ben, you can play with this on your own, Ben. I don't need to do it here. We got other questions to get to, but real quick, Ben just says, what probability of loss of 45, meaning you're right 55% of the time. Yeah, you can just run the numbers yourself. Let's go to radioactivetrading.com/trade.sim.asp. Really, just go to radioactivetrading.com, click the Resources tab, click on the Trade Simulator, play with it as how you want. Okay? All right. Now, honestly, there's very few people I know who are making this at all, who are getting a 10% gain when they're right and only losing 5% when they're wrong. Because remember, making 10% on a long call position, I know most of you are looking for more than that, and that's fine, I do too. But 10% gain on a long call position and saying, oh, that only allocates, I'm only allocating 5% of my portfolio, so if I lose that, you know, it's only 5%, but I'm getting 10%. No, 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 no. You're not getting 10% return if you're saying that you're only risking 5% of your portfolio. You're not. You're risking 100% on the long call and only making 0.5% on your portfolio. Now you need to be really successful long term. If you're saying that you're making 50% on your long calls on average, that's true, but your losses are probably closer to 60 to 50% as well when that happens, okay? All right, so I want to get back to James's question, which he asked earlier. And we're going to back to power options for this. So let me clear off our drawings here. Play around with your numbers on the Resources tool there on the Trade Simulator, and let me know what you come up with. Let me know what numbers you guys see and what numbers work for you. Of course, that goes for anyone here as well. And Lance, you can try it with the 1 to 2%. Try that out. Try the 1 to 2% move, the 2 to 4%. See how that happens over different simulations over time. We can take maybe a question or more here before we wrap up. I just want to remind everyone, of course, that, there we go, today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions. I use the Intel position as an example, comparing why I feel the RadioActive 6-month out married put is a better structure than using a cheaper OTM put in the discussion of Lance's question on setting up a structure with a 5% risk for a 10% return. Is that possible 2 to 4 weeks out? Literally, I went to the search tool on PowerOptions, pulled up the 30 or so married put, suggested married puts matching the RadioActive default screen, narrowed it down to just those ones that had 5% risk, and Intel was one of the 3. So that's where I started. It's not to be taken as a direct trading recommendation of stocks to get into or stocks to buy. Options do involve risk, may not be suitable for all investors, but of course we talked today about trading plan, about the tools that can help you develop that. You can develop the trading plan with the trade simulator tool to help you decide what would work and what wouldn't work. And we talked about what might be realistic and unrealistic based on even our audience answering those 2 poll questions we asked regarding what are our expectations as a trader, of course, and what are we actually achieving. You know, so we said, what do we think? Let's just put it up again. What do we think is a reasonable, this is for everyone out there, what do we think is a reasonable target per year with the options portion of your portfolio? 8% said 50% per year. 8% said 30 to 35% per year. 42% 20 to 25% per year, and 42% anything above 5% is just gravy. Okay, and then we talked about what we were actually achieving as well, and it wasn't quite as close, but kind of. You had 25% saying 3% per month, fantastic, and 75% are realizing that 1-2% per month, which comes out to 12 to 24% per year. So why I brought that up is even though we might be expecting only a 50-50 win ratio, if I'm looking to make 10% when we're right, when Lance was asking 5% when I'm wrong in the first 30 days and I'm right 50% of the time, I'm still coming out ahead, but maybe more closer to 5 or 6% per month, which is not what anyone's achieving and is on the higher end, sort of that 60-70% range, that really only about 8% said that they are reasonable expectations. That might be a little bit too high, but again, it all depends on the win-loss ratio and the structure of the trade that can actually get you to those goals as well. And that's what PowerOptions can help you with also. That's why we're here on the webinars. That's why we offer this coaching sessions for trial members and subscribers. As I mentioned, Ernie and I are not financial advisors, but again, we can talk about a trading plan, talk about the structure and which strategies might get you to the risk-reward ratio you want, but then show you why that may or may not be likely based on your success rate, probability, market conditions, and more. Okay, so that's my disclaimer. If you wanted to test out any of the tools you saw today, that portfolio tool to track and manage your positions and evaluate position analysis, those rollouts aren't only shown for covered calls, they're shown for other spread positions, buying call options, married puts, of course, collar spreads, diagonal spreads, and a lot more. You can test out PowerOptions for free at any time. Just go to powerop.com, put in your name, an email address, click Start My Trial, and you have full access to PowerOptions for 14 days, no billing, no credit card required. After that, our subscription level started only $45 per month, monthly service. Most popular one is our 20-minute delayed service at $65 per month. You can also upgrade that if you want access to the historical tools. Our historical database goes back to April of 2006 for backtesting purposes, viewing historical options chains. And of course, we do offer a real-time service and then a full package that includes everything as well. Other free education and free stuff, hey, we talked about that blog article. I sent everyone the link there, blog.powerop.com. The Balanced Approach for Portfolio Success is the title. But you can just do a search on the blog for Barbell, and it'll come up if you missed the link earlier. Also, you can check out our webinars at any time. Just go to powerop.com/webinars.asp. Some of the webinars are not available if you're not a current trial member or subscriber. That's just another reason to take a trial or subscribe. But you can hunt around on YouTube, our vast array of many, many videos over the years that are archived publicly and available on YouTube, just under user PowerOptions as well. All right, ladies and gentlemen, I did not see any other new questions come in. Let me see here. Let me just check to make sure. But if anyone thinks of any questions later on, send me an email at any time. Just send it to support@powerop.com, or, of course, you can send it to support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. Unfortunately, I don't think I'm going to be available on Monday, but I will be, of course, available later in the week as well. And if you are a trial member subscriber, you can schedule one of those coaching sessions at any time. What is a coaching session? Typically, it's essentially what we just did today. And there's a little bit of sales in there about the benefits of the PowerOptions tools, but most of my coaching sessions that are scheduled are exactly what Lance was. I get a question from the person about a certain strategy or trading plan or structure, and I walk through and give the answers. Yes, of course, I mentioned products that will help them understand that, or the tools and PowerOptions that will get them to their goals. To sort of subscribe, that is part of my job. But just like you guys are free to ask questions here on anything that you have without getting a huge sales pitch, that's essentially what the coaching sessions are. It's just me and Ernie talking with you about our options knowledge and what we think about your trading plan, what we think about your structure, or, hey, how to set up the search to match your specific goals. So it's as simple as that, and they're completely free. You can have as many as you want, too. It's not just one and done. But trial members and subscribers can have a coaching session at any time. Just click on the link there underneath the Home tab and schedule a session that matches your convenience. Well, ladies and gentlemen, thank you once again for joining me this afternoon. I hope you all have a fantastic weekend, and look forward to seeing you next Friday or possibly next week on another live presentation. We'll let you know when this webinar is archived and posted to the archives and on YouTube, so you can watch it at any time. Take care, everyone. Have a fantastic weekend. Good night.